Before I begin, I want you to imagine a scenario in the financial markets that appears to be a triumph of innovation, efficiency, and prosperity. The crowd is cheering, analysts are raving, and influencers shout confidently into every camera they can find. But underneath the optimism, a subtle shift is being engineered that will rewrite the supply dynamics of one of the most important digital assets ever created. It will not happen with loud announcements. It will not arrive with panic or celebration. It will unfold quietly, mathematically, and inevitably. And when it does, millions of tokens will disappear, not by accident, but by design. That is the real story of Ethereum's next upgrade. Not hype, not headlines, just unavoidable economics. And unlike most people in this market, I prefer to pay attention to what the numbers say, not what the crowd believes. Because the crowd rarely understands what it is applauding. I have never been especially interested in what popular sentiment expects. Prices are noisy, emotions are irrational, and market narratives are often formed by people who profit from attention rather than accuracy. But supply mechanics are different. Supply changes don't care about emotions. They don't need optimism or fear. When supply contracts, scarcity increases, whether the market understands it or not. And in Ethereum's case, we are on the brink of a new phase where the network will deliberately decrease the number of coins in circulation at a rate that the majority of investors still underestimate. This is not merely a reduction in inflation. It is a forced purge. A programmed scarcity event built into the structure of the network itself. And once you understand the math, you understand how inevitable this process is. You don't need predictions, guesswork, or excitement. You simply follow the incentives. That begins with something most investors still underestimate: the burn mechanism that permanently removes ETH from circulation every time the network processes transactions. Markets have not fully absorbed what this means because they're looking at it with the wrong mindset. They think burning is a minor deflationary force, similar to a stock buyback. But it's more aggressive than that. A stock buyback can stop. Burning cannot. A stock buyback is subject to cash flow, debt, and sentiment. Burning is subject only to usage. If a network grows, if transactions rise, if decentralized finance expands, if tokenized assets explode in adoption, then the burn rate grows alongside it. It is not discretionary. It is automatic. And Ethereum's next upgrade creates economic pressure that amplifies that burn without needing new hype cycles to sustain it. When people look at Ethereum's future after the upgrade, they expect something dramatic and emotional, as if the market will instantly react with fireworks or panic. But real value rarely announces itself loudly. Real value usually hides inside structure, mathematics, and incentives that work quietly, block by block, one transaction at a time. That is why most investors still miss the point. They see excitement in temporary price pumps, and they fail to notice the silent economic engineering that makes Ethereum more scarce with each movement on the network. They expect advancements in technology to deliver faster gains, cheaper transactions, or some kind of massive new event that looks impressive on a chart. What they don't understand is that the most powerful result of this upgrade isn't what gets added, but what gets removed. It builds its future not by producing more supply, but by destroying it. And the destruction isn't optional. It is encoded. The difference between narrative-driven markets and system-driven value is discipline. Most traders chase narratives because they're loud, emotional, and profitable in the short term. But Ethereum isn't creating scarcity through hype. It is crushing supply because the economics force it to. Whenever a system attaches value to economic activity and penalizes inefficiency with elimination, you end up with programmed scarcity. This upgrade doesn't need people to believe in it. It doesn't need influencers to evangelize it. It doesn't need millions of users overnight. It needs only one thing: continued network usage. And usage is something Ethereum has accumulated through years of stress, failures, experimentation, and evolution. The upgrade is merely the natural continuation of that history. It doesn't promise more wealth. It promises less supply. If you really want to understand why this matters, stop thinking about the price for a moment. Think about the behavior of an asset that becomes more scarce as more people use it. Think about a commodity that burns itself as it becomes more demanded. That's not speculation, that's physics. When Ethereum processes transactions, it burns ETH. When it grows, it burns more. That's not a feature designed for marketing. It's a structural punishment for growth. If the network succeeds, supply dies. And the more it succeeds, the more aggressively it dies. People believe scarcity is created by holding, by reducing selling, by waiting for the right moment. But in this system, scarcity is created by living, by functioning, by expanding. The network is programmed to eat its own supply as the price of survival. That's how programmed scarcity works. It doesn't rely on belief. It relies on activity. The stock market has seen versions of scarcity through buybacks, but those are discretionary choices. They stop when a company needs cash. They shrink when debt becomes dangerous. Ethereum scarcity does not pause when markets feel unstable. It doesn't care about recessions, interest rates, or geopolitical anxiety. If someone interacts with the network, scarcity happens. If the network is used even during a crash, scarcity increases. It rewards activity by damaging its own supply. This is why calling it a deflationary asset is a surface-level understanding. It isn't simply deflationary. It is economically self-destructive by design, and that destruction increases its long-term value without needing speculative momentum. You don't have to convince anyone to burn ETH. The network does it automatically, and no one can turn it off without collapsing the entire system. This is why the upgrade matters. Not because it promises growth, but because it ensures that growth becomes expensive for the supply. If the network expands, ETH disappears. If it stagnates, nothing changes. The downside risk is boredom, not inflation. The upside risk is scarcity so powerful that it becomes impossible to ignore until it's too late to position yourself calmly. That's the hallmark of a real structural transformation. People ignore it while it builds in silence, and then pretend they always understood it once the consequences reveal themselves in price. But by then, the destruction has already happened. Millions of coins will already be gone. And those who waited for noise will miss the value hidden in the silence. Investors love comparing things they don't actually understand. They talk about Ethereum as if it is just another asset going through a halving-like process. And they repeat that comparison because it feels familiar and comforting. People trust what they already recognize, even if the logic is flawed. They hear the word burn, and they immediately treat it like a slow reduction in creation. But that is a misunderstanding born from habit, not analysis. A halving reduces how fast something is printed. Burning destroys what already exists. One turns down a faucet. The other smashes the water tank. A halving lowers inflation, yes, but it does nothing to the coins already circulating. Burning erases circulating coins forever with no possibility of return. It is a completely different category of scarcity, and treating them as if they accomplish the same thing is how investors miss the real mechanics shaping value. In traditional markets, people are used to supply control coming from decisions, central banks adjusting interest rates, companies choosing buybacks, governments increasing or decreasing money supply. These are human choices. They can reverse, pause, or become politically manipulated. In cryptocurrency, most people still bring that psychology with them. They expect that scarcity must come from an event, a date, or a choice someone announces. They don't understand a system where scarcity is continuous and involuntary. Ethereum didn't choose to burn supply seasonally or occasionally. It burns because the system demands it. Every interaction costs a small sacrifice. Every transaction carries a toll that gets destroyed. There is no board meeting, no committee, no earnings call where somebody says, "Let's burn less this quarter." It is an indifferent economic mechanism that removes supply whether or not anyone wants it to. There is no off switch. The reason this matters is that a halving model relies on sustained interest to create value. If demand dries up, supply reduction becomes irrelevant. There is less new issuance, yes, but the existing pool stays untouched. Ethereum's burn, on the other hand, is tied to usage. As long as the network functions, whether in bull markets, bear markets, or sideways markets, existing supply is erased. Even in bad times, activity does not disappear. People still move assets. They still stake, swap, trade, and build. And every one of those actions carries a cost in blood, ETH, that never returns. This means scarcity is not conditional. It doesn't need optimism to exist. The network could be boring, and it would still consume supply at a pace that compounds over time. Boredom doesn't save ETH from destruction. Only total abandonment could stop it, and total abandonment is unlikely for the most used smart contract network in the world. Investors tend to underestimate the difference between theoretical scarcity and actual destruction. A halving tells you, we are printing less. Burning tells you, you will never see these coins again. Removing future inflation is a forecast. Eliminating existing units is a fact. Markets respond to facts, but they respond slowly. When something becomes scarce gradually, humans don't feel urgency. They assume there will always be enough later. It's the same reason people waste natural resources or ignore rising debt levels until the consequences become painful and irreversible. We are bad at recognizing slow erosion. We don't react until scarcity creates stress. And when stress finally appears, the reaction is not calm, it's desperate. Investors chase what they previously ignored. Access becomes expensive not because demand exploded, but because supply disappeared while everyone wasn't paying attention. Ethereum's burn is a gradual erosion that compounds into a future shock. It is not impressive on any single day, and that's exactly why people underestimate it. People only respect actions that are big and visible, not small and continuous. But small and continuous is where irreversible change happens. One transaction won't matter. 1,000 won't matter. A year of transactions matters. A decade becomes transformative. The final outcome is a supply structure that doesn't just slow inflation. It eats into the existing pie until less and less remains. And when the market finally wakes up to the difference between reducing issuance and destroying supply, the realization will not come with curiosity. It will come with urgency. Because scarcity that has already happened cannot be reversed, and that is what makes burning so significantly more powerful than halving. It creates consequences before anyone notices. People assume that cheaper fees and higher efficiency mean lower value, as if every improvement automatically reduces profitability. They think in straight lines. If something becomes easier, it must become less valuable. But markets don't work like that, especially when the asset's value depends on usage. Efficiency doesn't reduce value in systems where activity fuels scarcity, it amplifies it. Many investors don't realize the irony here. When Ethereum becomes faster and cheaper, it doesn't kill the burn, it accelerates it. Lower costs invite more transactions, more experimentation, more real businesses deploying tools on-chain, and each of those actions increases the rate of destruction. If a network becomes too expensive to use, activity slows down. If it becomes cheaper to use, activity expands. And in a system where usage equals supply death, increased activity is not neutral, it is catalytic. People will not stop using the network because fees drop. They will use it more. And more usage means more ETH that disappears permanently. Look at how digital ecosystems evolve. The most successful technologies are not the ones that maximize profit per transaction, but the ones that maximize the number of transactions. No one remembers the internet dial-up companies that charged per minute. They vanished because cheaper and faster access brought more users, more businesses, and more total economic activity. The internet didn't lose value when it became cheaper. It became indispensable. Broad adoption created new demand that overshadowed the drop in per unit cost. Ethereum's upgrade functions with the same economic logic. Lower gas fees are not a discount. They are an expansion mechanism. They invite more builders, more apps, more trading, more automation, more tokenization, more experimentation, many of which will not be speculative this time. The network becomes a marketplace of continuous action, each action burning microscopic amounts that add up to meaningful scarcity over time. People underestimate how many future industries will operate on chain without anyone investing in them directly. Micro payments between machines, AI agent spending, automated financial products, billions of small transfers representing tiny fractions of value, All of these possibilities make sense only when fees are negligible. When fees are low enough to enable millions of minor interactions, the total burn accelerates because scale replaces size. A single expensive transaction becomes less important than millions of tiny ones. Just as small purchases define the entire revenue structure of global commerce, small network operations will define the future burn rate of Ethereum. It won't be dramatic transactions that shape scarcity. It will be the invisible ones, the repetitive operations that no one pays attention to. The high-frequency usage that compounds invisibly. Investors consistently overlook scale effects. They believe that only large players, big trades, or high-value contracts drive economic outcomes. But the world's financial systems were built on volume, not size. Payment networks thrive on ubiquity, not exclusivity. Banks don't profit from one giant loan. They profit from millions of smaller ones repeated over decades. Ethereum's upgrade pushes it toward a similar model. The network becomes an infrastructure layer that powers constant, everyday use cases. And every one of those uses, no matter how trivial, triggers burn. The more efficient the network is, the more its destruction accelerates, turning cost reduction into a form of compounding scarcity. The mistake most investors will make is thinking that improvements lower revenue. They will view lower fees as a bearish indicator, while missing the underlying structural shift. They will see a cheaper network and assume lower demand, not realizing that the very reason demand has been limited is because fees have been too high. They will wait for big announcements, not small adoption patterns. They will look for visible catalysts, not slow multiplication. They will be right in the short term and completely wrong in the long term, because the real engine of value isn't excitement, it's usage. And efficiency is the fuel that makes usage explode. When something becomes cheaper to use, it becomes more widely used. When something becomes more widely used in a burn-based system, it becomes scarcer. And when scarcity increases through growth, not speculation, markets don't adapt gradually. They reprice violently once the data becomes impossible to ignore. When people look at staking, they only see yield. They treat it like a simple reward mechanism, as if the purpose of staking is to give investors passive income. They forget that the yield is not the most important function. The real consequence of staking is the creation of illiquidity. When ETH is staked, it behaves like an asset locked behind glass. You can see it still belongs to someone, but it cannot freely move into the market at a moment's impulse. It is removed from circulating supply, not permanently, but functionally. And functional removal is often more powerful than permanent destruction because it reshapes behavior. When millions of coins are locked to secure the network, they stop acting like trading assets and start acting like infrastructure. Infrastructure doesn't flip for profit, it doesn't panic sell, it doesn't speculate emotionally. It simply sits frozen, keeping the system alive while tightening the supply that traders mistakenly believe is available. Staking deeply alters market psychology because it attracts the exact type of holder that does not want to sell. The short-term gambler rarely stakes. The impatient trader rarely locks assets. Staking selects for people who are not actively participating in speculative churn. When they commit their ETH, they are signaling that they value long-term ownership more than short-term liquidity. But beyond their intentions, the protocol itself enforces discipline by preventing spontaneous withdrawal. Even when unstaking is allowed, there are time delays. Those delays become powerful because markets move faster than people can unlock coins. If a sudden rally appears, stakers cannot immediately sell to capture profits. If fear spreads, they cannot rapidly liquidate to escape. Locked coins create price stability not because holders are loyal, but because they physically can't react as quickly as the market demands. The biggest misunderstanding is thinking staking adds supply because of rewards. Rewards are irrelevant if the newly generated ETH also gets staked, which most of it does. The net effect is a growing vault of inaccessible supply. And institutional staking magnifies this problem. Large entities don't stake with emotions. They stake with strategy. They seek reliable yields, predictable policy, and long-term certainty. Once they allocate, they commit. Their decision-making is slow, bureaucratic, and inflexible. When a corporation or a financial fund stakes millions of dollars in ETH, they are not exiting because of market noise. They will not respond to hype cycles. They will not read social media sentiment. They are not chasing momentum or reacting to panic. They behave like long-term bond holders, not day traders. And when assets behave like bonds in a system where supply burn continues simultaneously, you get a paradoxical effect: scarcity from both sides. Supply is attacked from two directions. Burn removes existing coins permanently. Staking hides millions of coins behind economic glass, where they exist but no longer behave like liquid supply. If staking penetration grows beyond a certain threshold, the circulating liquidity becomes dangerously thin. A market with thin liquidity is easily disrupted. A small influx of demand can move prices dramatically. A small panic can do the same, except staked coins won't participate in the panic. That imbalance creates fragility. The most ironic part is that staking makes the market appear calm on the surface, because fewer coins are moving. Stability becomes an illusion. The market looks tame not because risk disappeared, but because the liquidity required to express risk has been locked away. Everyone becomes a spectator until their unlock periods expire, and by the time they can react, the market has already changed direction. Staking, therefore, is not just a yield mechanism. It is an economic filter that locks up supply in slow, moving hands. It removes coins from the battlefield and leaves traders fighting over a shrinking pool of liquid assets. They believe they are trading ETH, but they are actually trading the leftovers of ETH. Millions of coins are unavailable, sitting in staking pools waiting to be unlocked at a pace incapable of matching market speed. And when this dynamic intersects with rising demand, even moderate demand, price discovery becomes violent. That violence doesn't arise from hype. It arises from scarcity that is partially invisible. Investors will think the market is quiet until one day it isn't, and they will be confused about why prices moved so aggressively on seemingly ordinary news. The answer will not lie in sentiment, narratives, or announcements. It will lie in a supply that was quietly removed from circulation, hidden in staking contracts, waiting for a moment when the market learns what illiquidity truly means. Most investors love the idea of rising prices and shrinking supply because it gives them a simple, comfortable storyline to believe in. They want a chart that looks like a staircase going up, a narrative where demand increases forever, and a digital asset that magically becomes more valuable just because there are fewer units of it available. But this idea, while emotionally satisfying, leaves out a critical point: scarcity means nothing without velocity, utility, and cost of use. A market can destroy millions of coins, compress supply, and still fail to create price appreciation if the asset ends up frozen in place, too expensive to use, or too slow to circulate. In that scenario, scarcity becomes a dead weight, not a catalyst for growth. When the upcoming upgrade introduces deeper burn mechanics, people assume that fewer coins equal higher value. What they miss is the structural risk created when supply is locked away or burned faster than economic activity can justify. Instead of a healthy, growing economy, the blockchain risks becoming a stagnant vault holding wealth that no longer circulates. Imagine a city removing cars to reduce traffic. If the city removes a few thousand unused cars, traffic improves. But if it aggressively scraps millions of cars while people still need to travel, movement slows down, business suffers, and the system collapses under its own restriction. Crypto ecosystems behave similarly. Burning coins isn't a universal benefit. It is only beneficial if the network continues to attract liquidity, transactions, users, and builders. Without active circulation, decreasing supply can crush an ecosystem the same way excessive taxes do. The problem is not that coins disappear. The problem is whether economic energy remains. If transactions fall because fees become deflationary and unpredictable, validators reduce staking participation, developers move to cheaper platforms, and users migrate toward convenience. Supply shrinks, but so does demand. This becomes a deflationary trap where the asset becomes so valuable to hold that no one risks using it. People stop spending because they believe tomorrow's value will be even higher than today. The blockchain, which needs continuous transactions to survive, ends up starving itself of the very activity that supports its price. This is where investors misunderstand the nature of assets that burn supply. They confuse speculative scarcity with productive scarcity. Speculative scarcity is like a rare stamp, appreciated because it is rare, but useless otherwise. Productive scarcity is like oil. It becomes valuable because industries consume it to create more value. A blockchain token only has productive scarcity if it fuels transactions, smart contracts, staking, liquidity, and real-world integration. If the new upgrade makes the asset too deflationary, it begins to resemble a rare collectible rather than a functional economic unit. A network can't grow if its core currency becomes too expensive to spend. The economy stalls. The developers hesitate to build. Each decision to hold instead of transact adds friction, and friction destroys momentum. The market assumes burned supply guarantees future price appreciation, but markets rarely reward linear thinking. If fewer coins exist but fewer transactions occur, the network enters a paradox. More value trapped inside an economy doing less work. Traditional markets have warned us about this repeatedly. Economies with aggressive deflation do not thrive, they freeze. Assets become ornaments instead of tools. Investors hoard, businesses die, growth evaporates. A blockchain facing the same dynamic doesn't become a futuristic financial system. It becomes a museum with shiny, valuable artifacts that no one touches. The real danger is subtle. It won't happen overnight. Prices might rise initially, reinforcing the illusion. Investors will feel victorious, unaware of the decay underneath. But a system that incentivizes holding too strongly creates a future where there are no users left to generate economic value. The supply burn may not ignite a rally. It may suffocate one. The narrative that blockchain innovation always propels growth is comforting, but it is also dangerously misleading. Progress is not defined by how complex a blockchain becomes, how many coins it burns, or how many technical upgrades are announced. Progress depends on whether those innovations attract new participants, increase economic activity, and strengthen network incentives. When a major upgrade radically alters staking rewards, validator economics, or burn mechanics, it can create a system that is structurally hostile to the very people required to maintain it. If the network becomes more expensive to validate, harder to profit from, or slower to generate revenue, the incentives that bring validators, developers, and liquidity providers begin to erode. A blockchain, without people maintaining it, is no longer decentralized. It is hollow infrastructure held together by a shrinking group willing to carry a growing economic burden. Investors often associate upgrades with growth because they view blockchain through the lens of software where updates improve performance. In economics, however, upgrades can destroy value if they disrupt incentives. Think of a factory that installs new machinery to save costs but increases maintenance complexity. If workers can't operate it easily, if repairs become expensive, or if productivity drops due to confusion, the upgrade becomes a liability. The same happens in blockchain ecosystems when rewards decrease while the network demands more from participants. Validators might reduce their hardware investment. Smaller stakers might unstake and leave. Developers might shift to ecosystems where costs are predictable, rewards are stable, and growth is supported by a balance of scarcity and liquidity rather than aggressive deflation and uncertain compensation. The market is infatuated with scarcity, but it forgets the most basic economic truth: there must always be enough reward to justify participation. If staking returns fall due to excessive burns or reduced issuance, the network becomes less attractive to the people who secure it. If transaction fees shrink overall due to falling activity, validators generate even less. Over time, the economic load falls onto fewer participants, causing greater centralization as only the largest players can afford to keep validating. That is not decentralization. That is a technical oligarchy where a handful of major actors control security. Ironically, this results from the same mechanism that investors cheer for: reduced supply, lower rewards, and deflationary economics that look profitable on paper but weaken network resiliency in practice. Deflation is not automatically beneficial. It is only valuable when it serves a functioning, growing economy. In a network where growth slows, deflation becomes a deterrent. People hold the asset, waiting for higher prices. Validators hesitate to invest. Developers analyze risk and consider alternatives. This quietly corrodes competitive advantage. Other blockchains with simpler mechanics, higher rewards, or lower costs become appealing not because they are better technology, but because they offer better economic reliability. Investors assume competition in crypto is driven by innovation, but economic incentives matter more than innovation. People don't build where it is theoretically advanced, they build where it is economically rewarding. Many believe the upgrade will strengthen the asset, but they are observing from a narrow angle. They measure scarcity, but ignore participation. They celebrate reduced issuance, but overlook the shrinking validator incentive. They applaud the burn mechanism, but fail to ask who will maintain and build on a network that rewards less and demands more. A healthy blockchain does not choke its participants with deflation. It ensures that every actor in the ecosystem sees a reason to stay. If the new upgrade fails to balance scarcity with participation, it risks transforming a growing economy into a quiet, expensive shell. Investors cheering for fewer coins may soon face a more troubling reality: fewer builders, fewer validators, and fewer users. And a digital asset without an economy is just a number on a screen with no world left to give it value.